Futures improving after this hour's inflation data. Joining us right now on the markets and maybe a comment on where inflation really is headed, JoAnne Feeney, partner and portfolio manager, Advisors Capital Management. You got a take on all of this morning?
Yeah, good morning, Andrew. Well, don't look a gift horse in the mouth. The U.S. economy is doing very well. We saw that with the retail sales, the GDP report, obviously this morning's inflation data showing continued strength in consumer spending and tapering down of inflation as the Fed has sort of suggested that might happen. We're starting to see it, which is really good news. And so the investor, I think, is well positioned to have an investing environment that's very solid, and growth, as far as we can tell, is likely to continue, although we do expect it to moderate.
Do you think, and I thought Judy Shelton's comments have been quite interesting. There's been a sort of larger debate about whether inflation's coming down as a function of the Fed or in spite or despite it. The answer actually matters in a way because it could give the Fed flexibility to actually lower rates if, in fact, you think that they're less relevant, oddly enough, in terms of having a major impact.
Yeah, no, I think both things are going on, right? I think it's correct to state that the initial pulse to inflation was from shortages and the fiscal spending that happened to keep households afloat during the worst of the pandemic certainly fed into spending capability. So demand sustained, low supply, inflation. I think the Fed's response to that was because it just took longer for that to go away. But it was important. It was important for the price of money to be raised to levels that were in line with what was happening in financial markets. So I think the Fed needed to do that. I think it continues to need to keep interest rates sustained because I think that's where the price of money is sitting right now. And so for the Fed to cut prematurely would inject an amount of liquidity into the system that could undo some of the good effects we're starting to see.
Okay, so then your gamble, to the extent you gamble, but maybe we're gambling everywhere, is what in terms of what Jay Powell does next?
Yeah, I don't think he's going to cut as soon as the market does. I think we're looking at the second half at best, but it's going to depend on what the numbers do from here to there.
And what does that mean for equities between now and then?
Well, I think the long-term interest rate's not going to move that much. I think this is all about short-term rates. And in terms of valuations for, say, growth companies, it's really the 10-year that you care about. And I don't see that moving a whole lot no matter what the Fed does. I think that's pretty well anchored by long-term inflation expectations and long-term growth expectations. So for an investor, I think it's safe to be investing in growth stocks at this point. In fact, if anything, there'll maybe be a slight tailwind if those longer-term rates come down a little bit. But otherwise, I think it's sort of, clear sailing in some ways. Build a portfolio, include some growth, and include some of those sectors that really got beat up last year because of those higher interest rates.
Okay, clear sailing, a good message. I hope that's right. We'll save the tape in case it's right or wrong. JoAnne, we always appreciate seeing you and getting your perspective on all of it. Thanks again.
You bet.